You may be wondering what the difference is between an actively managed fund and a passively managed fund. That's what I'm going to be explaining in this video. Hi, I'm Camille Gaines, founder of financialwoman.com and author of Earn, Grow, Give. I'm a financial coach, but I've personally been investing for over 30 years, and here I share what I've learned during that time frame, the good, the bad, and the ugly. So a lot of people are unsure about mutual funds, or actively managed funds that are managed by a financial advisor or wealth manager. So in this video, I want to make it really clear the difference between the actively managed funds and the passively managed funds. I've been talking a little bit about this, and so you'll want to see my other videos on this topic. But an actively managed fund simply means that there's a manager, or more commonly today, a team of managers and researchers that are making decisions about which stocks to buy based on what's going on with certain criteria that they're looking for. So they may be looking at price, or they may be looking at technical analysis, or they may be looking at certain factors. And they commonly go visit companies in their decisions to choose which companies to invest in. Now, actively managed funds, because they do have this active manager or active management team, and they do so much research and have to rely on the research department to help with all this, they are going to cost more than an index fund, which is what's referred to as a passively managed fund. So with an index fund, you may have heard me say here before in other videos, an index fund is simply, it holds the securities, stocks in this example, that are in an index. And an index is just a way to invest in the stock market, for example, by buying an index fund. So that index owns all the stocks in that particular index. They have a commonality. And for example, the S&P 500, which you've probably heard of, that's an index that is made up of 500 big growth type companies in the United States. So if someone wanted to buy into the stock market, then they could just buy that index fund, and they would have a well-diversified portfolio by having done that. But the difference between that and the actively managed fund is that passively managed fund or index fund simply bought the company's securities in the index, whereas the actively managed fund had that active manager buying and selling stocks based on the criteria that they wanted to use to invest. Now, having said that, actively managed funds, their goal is to beat the index or to beat those passively managed funds, because that's a measuring tool. Everyone expects to do as well as an index fund with an actively managed fund. Unfortunately, that's not always the case. In fact, more often than not, an index fund beats an actively managed fund. And that varies depending on whether it's a bull or bear market. And I won't go into all that in this short video. I just want you to understand the difference between actively managed funds and passively managed funds, because a lot of people have questions about that. And that's what I wanted to share in this video. If you found this information helpful, then click the link below, to like to let me know that you liked it, and subscribe to my channel. Thanks for watching.